First of all, what exactly is an oscillator? It's just an object or data that moves back and forth between 2 points. So kind of like in this image, you can see it moving back and forth between the top and the bottom, and it always falls somewhere between these 2 points. Does this image look familiar from the last module? We saw this image in the stochastic, parabolic SAR, and relative strength index or RSI indicators. They are all oscillators. If you remember from the last module, the oscillator told us when the market was overbought or oversold. So as fewer buyers in an uptrend or fewer sellers in a downtrend are willing to trade at the current price, the momentum begins to slow, and this is visually seen by the oscillator. So for example, you can see here we have the buyers are going strong, but the momentum slows down and the sellers take over and it starts dropping. Now this point here in the oscillator at the bottom and this point here at the top, when the momentum is changing, oftentimes will tell us that the trend is changing or weakening, and it's possible that the market is going to reverse. Let's look at a couple of examples together. Here we have the pair USD JPY, and we threw on 3 different oscillators. We have the stochastic, parabolic SAR, and RSI, which are all leading indicators. You can see all 3 indicators right here, parabolic SAR, the RSI, and the stochastic, that they all line up perfectly at the top before the downtrend, and here as well, they all 3 line up perfectly at the bottom before the uptrend. You could have won about 500 pips on each of those trades if you'd caught the entire trend by getting in at these points. But now let's look at an example of when the exact same 3 oscillators mess up, so you can see how these indicators aren't always perfect signals. So as you can see here, the indicators are completely conflicting one another. Sometimes 2 indicators match up, like right here, this is indicating sell, right here, this is indicating sell, but sometimes a third one will have no signal. Or sometimes one will say to buy, another won't have a signal, another will say to sell, or sometimes one will say to buy and 2 will say to sell. And you may see this and wonder which indicator to follow, right? Well, if you had sold here, for example, where the RSI and the stochastic match up signaling to sell, but the parabolic SAR says to buy, you would have had a loss for sure. And same on this next signal, right? Because you can see, obviously, this would have been a good chance to buy, not to sell. So why aren't the indicators perfect every time? It's because they're all calculated differently. Leading indicators just aren't always going to be 100% accurate. They can't predict the future. And that's why I suggest that you have some type of leading indicator in your strategy, like maybe RSI or any of these examples here, but you should combine this with other indicators that aren't leading indicators. This will give you more confirmations of good entry points, and you'll have a lot more confidence with each trade since you aren't basing your entry criteria solely on leading indicators.
Hey, thanks so much for watching. Make sure you join our free Discord channel to get access to all the cheat sheets and a bunch of other cool bonuses. The next video in the course is right here.